I'm Rick Plum with this week's Lucia Capital Group Weekly video. Required minimum distributions, RMDs, from your retirement plans can be a really tricky thing to navigate. As you probably know, RMDs are withdrawals you have to make from most retirement plans when you reach the age of 72. Now, it was 70 and a half for those of you born before July 1st, 1949. The amount you're required to withdraw depends on the balance in your account at the end of the previous year and your life expectancy as defined by the IRS. Missing your RMD could result in you paying a penalty tax of 50% of the amount that you missed. That's not good. The more you know about RMDs, the less likely this will happen. So here are a few important details that you need to be aware of. First, there's a grace period on your first withdrawal, but only your first withdrawal. Once you turn RMD age, you have an RMD for that year. However, you actually have until April 1st of the following year to get it done. After that, all subsequent RMDs must be taken by December 31st of each year. So if you do postpone your first one, you'll have two amounts to take the next tax year. Now, is postponing your RMD a good idea? Maybe, but you should know that taking that extra money out could push you into a higher tax bracket since each withdrawal is added to your taxable income. So proper management and knowing your tax situation is crucial here. Another thing to be aware of with RMDs is timing. In most cases, I like to see an RMD taken early in the year as opposed to later. We did an entire video on that topic fairly recently, so if you want to know why I prefer an early RMD, I urge you to check that out. We'll put the link in the video description. Now, one question I sometimes get from people is this: if the markets are down early in the year, isn't it better to wait to take the RMD and hope they recover before the end of the year so that I'm not selling off an asset when it's down in value? Well, here's the good news about that. You don't have to take the RMD in cash, which means you don't have to sell an asset for cash when you want to take your RMD. If you want to hang on to it, you can take it out of the account in kind and simply pay the taxes on the current value. And given the situation that the value is lower than it was before, isn't it better to pay taxes on that lower value and then allow any potential recovery to happen in your personal account? You bet it is. This is where working with an advisor can be especially helpful. Another thing to know about RMDs has to do with multiple accounts. Your RMD for IRAs is calculated from the total of all your IRAs combined. They look at it as one pool of money. So as long as the correct dollar amount is taken, it can come from just one account or be spread among the various traditional IRA accounts you own, evenly or not. This can make things quite a bit simpler since you don't have to take separate distributions from each IRA. However, you can't do this with company retirement plans like a 401k or 403b. If you're retired completely, you'll have to take separate RMDs from each 401k, 403b, 457, or other retirement plan that you own. As I said earlier, these RMDs are added to your taxable income, which means that if they are large enough, they may wind up pushing your Social Security benefits into the taxable column and may also subject you to a higher Medicare premium. Because of this, the time to think about your RMD is not when you're required to begin taking them out, but probably several years before that. If you can find a way to reduce your RMDs ahead of time, you may save yourself a lot in taxes later on, maybe for the rest of your life. Yes, RMDs can be tricky. We at Lucia Capital Group strategize with our clients every single day on ways to potentially build RMDs into the plans and reduce potential negative impact of RMDs. If you're concerned about any aspect of RMD planning, give us a call. As always, we're here to help.